Ace market, 120 million ringgit market cap, sheet metal fabrication company. I mean sheet metal fabrication. Whoa, share price triple in 1 week. Hi, I'm Frankie. Welcome back to my fuck show. Probably in the making, Coraza IPO has impressed many investors, including myself. It is still a relatively small company even after share price tripled in just a week after the stock debuted on the 20th of January 2022. That said, with proper plans and strategies, it can turn into a really big company one day, and that's what I'll be talking about today. Originally, Coraza system was established by the Americans in 2001. It is involved in sheet metal fabrication to produce metal piece parts for one single customer, an instrumentation company. What's that? An instrumentation company basically designs, develops, installs, and manages equipment that are used to monitor and control machinery. For some reasons, just 1 year after operation, the Americans sold Coraza system to the current owners of the company for just 1 million ringgit. In the next 10 years, Coraza grew to be a company worth 39 million ringgit as a private limited company. What happened in these 10 years that resulted in such growth in the company? Well, they saw what the Americans couldn't see for sure. You see, 10 years ago, Penang was transforming into an E&E industry hub in the region. As the demand for Coraza products increased soon after the current owners bought over the company, Coraza began to build a new factory to cater for more jobs from more clients. In 2007, they even made a daring move. Coraza ventured into the aerospace industry, which is a very strict industry on the requirements of every product component. Aerospace business aside, Coraza's core is actually an integrated engineering supporting service provider, offering 3 main services to its customers: sheet metal fabrication, precision machining, and sub-modular assembly. Too many bombastic words, headache. But basically, it takes raw materials like this to transform them into this and this. And if the clients are too lazy to deal with those parts, Coraza can help to assemble them together too. Kind of like what IKEA offers to help you assemble a big item of furniture after you made your purchase. Coraza is so good at what they do. They start to get involved in the design and development of their clients' products. Smart. In order to understand what your clients really want, nothing comes close to participating in the D&D process directly with clients. If the clients come up with some weird, fancy designs that Coraza cannot deliver, at least Coraza engineers can propose alternative solutions that serve the same purpose on the spot. It looks bad to tell the clients that you cannot deliver what they ask you to do, right? From there, the clients don't give you purchase order for mass production, also cannot lah. Coraza knows this, but they bring this strategy to a whole new level. The D&D service is free! From client's perspective, wow! Free design and development. Take after that, Coraza knows our requirements so well already. Just give the job to them. Jackpot! Remember earlier I said that venturing into the aerospace industry is a daring move? It is one business that requires all components to be 101% precise to engineers' blueprint to ensure the safety of the finished product. Which means to say, not any Tom, Dick and Harry can simply enter the aerospace industry. Hey, of course lah. Would you dare to board a plane where the screws cannot fit perfectly into place one? Scary, man. Later, boom, mati. Today, the aerospace segment only contributes about 7% of the group's revenue. But to Coraza, it's okay. By having a foot in the aerospace business, Coraza sends a message to the world that not only are their existing products already top-notch, their engineering capability is better than top-notch of what other competitors could do. Later on in 2016, Coraza was selected as one of the 10 companies to join a secret mission code EPP8 or Entry Point Project 8. This project is an initiative by SME Corp Malaysia under MITI to gather the top 10 companies to build an aerospace supply chain network in Malaysia. If successful, we will be known as the aerospace manufacturing hub in the region, just like how Penang is the global E&E manufacturing hub today. If aerospace only contributes 7% of the group's revenue, where is the bulk of the revenue from? More than half of Coraza's revenue has come from the semiconductor industry since FY20, while the rest is quite evenly spread between instrumentation and medical products. As a whole, 3/4 of the group's revenue is in Malaysia, or rather from MNCs that have operations in Malaysia. The rest of them are from our neighboring country, Singapore. This is an important piece of information to investors.
Write that down, write that down!
Because it tells us how sensitive is Coraza's revenue against foreign exchange rate, particularly the US dollar, as its Singaporean clients trade with Coraza using the dollar. According to Coraza's prospectus, every 10% fluctuation in the ringgit against the dollar will affect Coraza's PBT by 2 million ringgit. 2 million ringgit may be a small figure, but don't forget that Coraza's PBT in FY20 only stood at 8.6 million. So, to put the forex sensitivity in perspective, if the ringgit suddenly strengthened back to 380 against a dollar today, about 1/4 of Coraza's PBT would be wiped out. That's how dangerous it could be for them. As an investor, I like to wear people's shoes. I like to put myself in the shoes of the corporates to help me rationalize the management's actions and decisions.
Oh, wise guy, eh?
So, let me ask you, if you have a business as well as Coraza, under what circumstances would you sell part of your business away, meaning sharing your profits with other people, and at the same time spend money to buy more land to build new factories? Now, before you conclude your answers, be mindful that both events add up have a double whammy negative impact on your wealth. On one hand, you are going to share your profit with strangers. On the other hand, you plan to spend a huge chunk of money to build a new factory. The answer is simple. I will only share that much with other people only if I know I could get a lot more returns in the future. By saying I know I could, I have to be quite damn sure that I could. If not, I just wouldn't take so much risk in the first place. Based on its track record, Coraza spent roughly 5 million a year on capex to expand its production capacity and buy new equipments. This time, Coraza did this IPO exercise to raise 33 million ringgit for its next 3 years capex plan. That's an average of 11 million ringgit spending a year, or double of how much they usually spend. Are they out of their minds? Well, you are in their shoes. Why don't you tell me? Okay.
Wanna learn how to tie your shoe? It's a very easy thing to do. Just sit on down and I'll give you the scoop. What's that?
It's called finding clues to make sense of business plans.
I'm a genius!
First of all, the management takes 19.5% of the 33 million ringgit to construct a new factory. Then it puts in 15.5 million or 47% of the IPO proceeds worth of new machinery in that new factory. After that, since the factory cannot run by itself, Coraza will invest another 1.2 million ringgit in ERP system to streamline business processes. And voila! A brand new money-making machine is ready to run. Oh, not to forget, having a new factory isn't enough. Coraza also allocated another 1.5 million ringgit to extend the existing building. So how do you feel now in their shoes? Upon its debut on the ACE market of Bursa Malaysia, Coraza registered a market cap of 120 million ringgit, which represents 19 times of FY20 PE valuation. Based on available data in Coraza's prospectus, it feels like this pair of shoes can make investors run like Usain Bolt. Not like the other company that we discussed recently, selling home appliances only but asking people to pay 28 times PE. Your washing machine can fly, man. Come to think of it, maybe both companies IPO around the same time, so investors saw the drastic growth differences and valuation gap between both companies and made a comparison. I think that's part of the reason their share prices are at where they are today. Anyways, as an investor, we cannot just look at the upside. We must also look at the downside, left side, right side, and the back side before we put our money inside the company. In my opinion, the biggest risk that Coraza has is that the group is still pretty much relying on its top 3 clients for business, which contributed more than 2/3 of Coraza's revenue. Having said that, the percentage has improved over the years. Just 4 years ago, their top 3 clients conquered 3/4 of the group's revenue. If at any point one of the 3 decided to cancel their order with Coraza, I'm sure there won't be the Coraza we know today. With the new facility coming up with the IPO proceeds, I'm guessing that they are going to get a bit more aggressive looking for new customers to fill up the capacity too. In short, it's an exciting time ahead for the group and I look forward to seeing how their story develops. That's all we have for today. #fuck.